Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
I am looking at my Bloomberg, looking at those FOMC minutes, and they are just coming out. Mike McKee, you're on it.
When they met, guys, the Fed officials looked at the economy and saw that it was good. Rate cuts were justified, but caution also called for going forward. Growth was stronger than expected. Upside risks to inflation small and little changed. Downside risks to the labor market had decreased. The outlook supported another quarter-point cut in the federal funds range. Although members were at pains, the minutes say, to note that policy was not on a preset course, the dangers from letting policy get too tight match those from letting policy get too loose, that they are data dependent. Among the upside risks to inflation, sudden disruptions to global supply chains, a larger than expected ease in financial conditions, stronger consumption, more persistent housing price increases, and those recent sharp increases in insurance costs that we have seen. Several participants noting that their contacts in companies larger in sectors like financial services, construction, professional services, technology were more optimistic than smaller firms and firms in manufacturing. Interesting thing, they did not mention at all the election in the minutes. Although strikes and hurricanes had affected recent labor market indicators, participants generally noted there was no sign of rapid deceleration in labor market conditions. Two other things to watch: a discussion of financial stability and vulnerabilities that participants assessed warranted monitoring, unrealized losses on bank assets, and risks in commercial real estate. And one note for trading desks. Some participants suggesting at a future meeting the committee consider a technical adjustment to the overnight reverse repo rate to set the rate equal to the bottom of the target range of the federal funds rate. That would put it in alignment with the existing structure when the facility was established.
All right, Michael McKee, obviously they're at the Fed breaking down those latest FOMC minutes, that of course from the November 6th, 7th Fed meeting that was after the election. All right, Mike, big dump in terms of what you got from that release. You know, we go to you to kind of parse through it and what we need to know. What does the Bloomberg audience needs to know? What stands out for you, if anything?
Well, not a lot stands out because it's pretty much as has been described by Fed officials since then, and of course, as Jay Powell described it in his news conference following the meeting. The conditions were pretty good for the economy, better than expected in terms of growth and unemployment. Inflation had stalled out a little bit, but they still didn't think it was going to be a problem to get it down to 2%, and so rate cuts were called for. But because the future was uncertain in terms of what was going to happen with inflation and the unmentioned election, they wanted to make sure that people know they were data dependent and they are not on a preset course.
Well, that's what kind of strikes me, Mike. One of the headlines that you mentioned, and it's what we call a hot sticky right here at Bloomberg, you know, that the Fed some saw pause or faster cuts as options depending on data. So, you know, what have we been saying ad nauseum, right? They're data dependent. It sounds like they could go kind of anywhere, perhaps at the December meeting even, but definitely in 2025.
Well, definitely. Now, the December meeting is open because the data have been mixed, and we have seen a little bit stronger inflation in both the CPI and PPI, and it's forecast to come out tomorrow in the PCE a little bit stronger. And if that's the case, then there is a case for pausing. We'll see what happens with the labor market. If the labor market comes in strong, if the jobs report on December 6th is strong, then you could probably start to bet on the idea of a pause in December. But you get the impression that they are at this point thinking they're going to go in December and maybe pause in January once we get the new administration in place. We're going to get a new summary of economic projections, a new dot plot in December, and how do you predict anything at this point?
Well, that's where I wanted to go, and we are going to talk to you more about tariffs in just a minute, Mike, but we help us understand how the Federal Reserve thinks about potential policy from a new administration. We heard Jay Powell ask this question earlier this month at the press conference, but they do have to look at what tariffs could do to growth or what policies could do to growth in order to make these decisions, right?
Yes, but they have to look at, as you say, what it does to growth or to inflation or to the labor markets. And at this point, they don't have any idea. There are a lot of slogans out there. There are a lot of tweets out there, but there isn't any policy out there. And until they have a policy, they can't really measure it. Now, I'll give you one example, and I know you want to move on to tariffs. We'll talk about this. This tweet that came out last night about tariffs from Canada and Mexico. There are something like $40 billion worth of automobile parts that come into the U.S. from Canada and Mexico. But they cross the border many times. There are some things like automobile seats that cross the border 7 times. How many times are those going to be tariffed? Will they be tariffed? And that's the kind of thing that the Fed doesn't know, and it's impossible to model at this point.
Well, that's what, I keep thinking about that, Mike, in that, Donald Trump then President Donald Trump imposed tariffs during his first administration. They carried, or some of them carried over into the Biden administration. And I am curious, when I get to speak with someone like you, is, what impact did those tariffs have on U.S. economic growth? What did they have on kind of the cost of things, the inflationary picture? Is there kind of a net takeaway as we now consider potentially another round of tariffs to cut?
Well, there have been a lot of studies on those tariffs, and there's 2 points you want to make. One is that there are some specifically targeted tariffs on especially Chinese electronic products that are done for national security reasons. But the broader general tariffs basically raise the cost for Americans. Consumers paid the cost of those tariffs, according to almost every study that has been done. And it also brought down the number of jobs, not raised the number of jobs. It held the number of jobs created down and slowed growth a bit. Tariffs in general, just broadly applied, do not have a positive effect on the economy. And that's pretty much according to every economic study that's been done.
I do wonder to what extent, and look, again, these aren't policy. We're going by Truth Social. We're going by posts from the incoming president. But no question that if you're an executive at one of these companies that could be affected by tariffs, you're certainly thinking about your supply chain today differently than maybe you were thinking about it just a few weeks ago, Mike. I do wonder about the economic effects of something like this and whether or not it could be looked at as, okay, maybe this is just a bargaining tool. Maybe this is being used to threaten, but actually be used as leverage, as some have suggested.
Yeah, the question I have that I would pose to people who make that argument is, what are they negotiating? Canada and Mexico basically have free trade agreements with the United States. There aren't any tariffs on most products. So what is it you're looking for? Are you trying to get the Mexicans to stop people at the border? Well, that's sort of already happening under Biden now since last June. The amount of fentanyl coming into the country has dropped a lot, and China has pulled back on the amount of fentanyl it's letting go through its borders to the U.S. So there has been progress on these things that you could say would continue. So what is it exactly that's being negotiated? That's the problem for companies, is they don't know. Are they actually going to throw these tariffs on day one, as Donald Trump's Truth Social said, or are these things going to be something that is for negotiation and are spread out over a period of time, in which case maybe you can adjust your supply chains a little bit. But a lot of companies brought their supply chains back to this side of the Atlantic and Pacific and put them in Mexico. And so if you're going to tariff Mexican stuff, then that's going to be a problem as well. So there's a lot of uncertainty out there for corporate leaders.
All right, and I just want to point out, as we're going to get into the next segment, you'll see who is our top. Of course, Mexico is our top trading partner with the United States. So we're going to talk a little bit more into that, and that is ahead of China. Hey, Mike, Thank you, as always. Michael McKee, International Economics and Policy Correspondent, right out there outside the Federal Reserve in Washington. Do want to point out that traders' reaction to those FOMC minutes have been a bit muted. Two-year yields slid slightly, more than 1 basis point, barely registers, right, in the context of some big moves earlier in the session. So for future yields are little change from before the minutes came out. They show policymakers are cautious about future rate cuts. The messaging from Fed officials earlier in the month that the December cut was in doubt seems to have done its job. So a little bit of weighing in by our team here on our Markets Live blog. Okay, so let's stay with U.S. trade and tariff talk. As we just mentioned with Mike, Donald Trump posted to his Truth Social network, vowing again to impose additional 10% tariffs on goods from China and 25% tariffs on all products from Mexico and Canada. Assuming President-elect Trump implements these policies in January, it could raise prices on everyday goods, including TVs and cars, but it's also a sign he's making good on his signature campaign promise, tariffs.
Tariff. I am a tariff man. To me, the most beautiful word in the dictionary is tariff. Build your plant in the United States and you don't have any tariffs.
All right, that, of course, was Donald Trump before the U.S. vote. Let's get more. Let's talk about what's going on a little bit more in terms of his proposals. Joining us is Henrietta Treyz, co-founder and director of economic policy at Veda Partners, joining us from Jacksonville, Florida. Henrietta, so great to have you here. Love listening to you when you join the surveillance team. Tell us about these proposals, your take, and what the implications could be for U.S., the trade picture, for our economy. What are your initial thoughts?
Initial thoughts are, everybody should be taking these tariffs very seriously, especially the China tariffs. I think they sound a little less bad than they ultimately will be. I mean, let's recall that there is $350 billion worth of goods coming in from China right now that already have 25% and 7.5% tariffs. When he says that he wants to increase the tariff by 10 percentage points, that means the 25% rate goes to 35% across lists 1 and 2, which is $50 billion worth of industrial inputs. And then on list 3, which is $200 billion or more than that on a lot of things that we buy at the groceries, at big box retail stores, flat screen TVs, things like that. Those tariffs are already on at 25%. So this would hike it further to 35%. With China, the biggest unknown and I think the biggest fear for investors and the Fed and consumers is list 4B. This is about $180 billion worth of everything that you buy at the grocery store, from a scented candle to a milk product, the powdered milk, things along those lines. And those have never been tariffed before, largely because they're so regressive and consumer facing. And those would start off under President Trump's tweet at 10% next year. Okay, well, Henrietta, I want to bring in some breaking news. The president-elect is poised to name Kevin Hassett to lead his National Economic Council. It's a role spearheading the new administration's tax, trade, and spending agenda. Bloomberg News reporting this, according to people familiar with the matter. Remember, he also backs the Republican slate of tariff proposals. He was the chair of the Council of Economic Advisors during President Trump's first administration. So anyone who paid attention from 2016 to 2020 is familiar with Kevin Hassett. The appointment will not become final until it's announced by Trump. What are your thoughts on this? What do we know from his role in 2016 and during Trump's first term, how he could implement tariffs this time around, or what it means for economic policy? And we know he backs the Republican slate of tariff proposals, so he seems to be all in on this. Yeah, absolutely. Kevin Hassett is definitely in on this. I would say this is very MAGA universe, tariff universe, strong policy announcement or personnel announcement. When I think of NEC director going into next year, the first thing I think of is this is the kind of person who would encourage the House and Senate Republicans to include tariffs in their tax bill. And that is something that I think is a real long shot. All the farming state senators have a real problem with this, along with specific members from individual states who don't like tariffs as a general U.S. policy. But this suggests to me that he'll be working most closely with lawmakers, especially on the House side, which is a more generous bunch to the Trump administration, the Trump agenda, than the Senate Republican conference. So look for Kevin Hassett to be somebody who coordinates more than, say, a Lutnick or Bessent on actually writing the tax bill next year. And then obviously having a cadre of control over tariff policy outside of Congress, within the White House, executive orders, things along those lines. That is a very strategic placement, and I think he will be integral into the tariff role. I think the most important person to wait for is still Bob Lighthizer, but this is an indication that the tariffs are very real. Hey, listen, Henrietta, what I'm wondering is we start to get ideas of what, especially
the Trump team when it comes to economic policy, trade policy, what it looks like. Are we increasingly building an isolationist policy for the United States, an anti-growth policy, which was kind of the antithesis when he got elected, because I think everybody thought ease in regulation, great for the business environment, pro-growth policy. How are you gaming that out?
Yeah, I don't see any of that in a whole bunch of different avenues. And I would start with, they talk about deregulation spurring exhaustive economic growth. And then they also talk about trimming $2 trillion or 3% of federal spending to generate budget savings and otherwise reduce the deficit. That's definitely not going to happen when you need 60 votes in the United States Senate. And then you also have this idea of a tax bill that is $4.6 trillion just to keep things static. That's not including new tax rate reductions for either corporations or individuals. And then you layer on the inflationary tariffs of 25% on Canada and Mexico, our biggest trading partners, as you point out, and then 10% across the board on already high tariffs against China. And we haven't even heard about his policy on the EU yet, which I think could result in auto tariffs as early as March 31st, when the Section 232 tariffs suspension expires.
I'm glad go ahead.
There's just a lot there.
There is. And I'm glad you mentioned the auto tariffs, because that's exactly where I want to go, but also the broader market reaction, Henrietta. I got to tell you, I'm a little surprised by the equity market reaction to this news last night. I expected to log in and see that stocks were down today as a result of this. Yes, you have GM and Ford lower as a result of our concerns of those companies being hit by auto tariffs. Why do you think there is a muted reaction in the equity market today?
I think Mike McKee said it exactly correct before. I mean, there's a misunderstanding, I think, between what has happened and what people expect from Trump. They see this as posturing and not serious. But point me to a tariff that he has not actually imposed. Point me to a tariff that hasn't been on for months, if not years. And in the case of China, 7 years worth of these tariffs. They are very real. They are not only real, they are a mandatory component of his economic agenda. When you try to pass a $5 trillion tax bill and say that you're going to get $1 trillion in revenue from tariffs, you must impose those tariffs to generate the revenue. So I think there's sort of willful disbelief.
Willful disbelief, or do you think the equity market has it wrong today and that he will follow through with tariffs such as these, because that's what his past behavior has shown?
I think that the market should be pricing in that these tariffs are very real. I'd layer on just a little bit further. I don't think that this is going to be the case with Canada and Mexico, but be mindful that it's not just a one-time hit. When you're building an automobile, you cross the U.S., Mexico, and Canada border multiple times just for the same vehicle. So is that 25% tariff on just one time, or is it on every single time it crosses between the borders? Because that could be a 5 times event.
Hey, 20 seconds. Is this going to be a problem for the U.S. economy?
Absolutely, especially if List 4B goes into effect. This is a huge problem and very disruptive on the Canada and Mexico front, which are our largest trading partners.
All right, great stuff. Oh my God, wish we had more time. Please come back soon. Henrietta Treyz, co-founder and director of economic policy at the investment advisor and consulting firm Veda Partners, joining us here on this Tuesday.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, folks, we did get some housing data today. Sales of new homes in the United States slumping in the month of October to the lowest in almost 2 years. 2 hurricanes, of course, hitting the South, and affordability challenges continue to weigh on buyers. We also got some data, Tim, on home price gains.
Yeah, this is really interesting. New single-family home sales decreased 17% last month to 610,000 annualized rate. That's according to government data issued Tuesday. Home price gains in the U.S. slowed in September, too, as buyers gained more negotiating power in the housing market. That national gauge of prices rose 3.9% from a year earlier. That's according to S&P CoreLogic Case-Shiller.
And I'm figuring it plays into supply and demand, but let's see what our next guest has to say, because she has a front seat when it comes to the housing market. Katie Hubbard is Executive VP of Capital Markets of the privately owned asset and real estate investment firm. They are Walton Global. They've got nearly $4.4 billion of land under management, over 90,000 acres under management throughout the United States, and they operate in the retail, industrial, and commercial sectors. Katie joining us from Denver. Katie, good to have you here with us. How are you, and how would you characterize the U.S. housing market today?
Hi, Carol. Hi, Tim. Thanks for having me. I'm doing well. And yes, we definitely see that October had a lot of noise in it. As you mentioned, we had 2 hurricanes. Mortgage rates rose in October quite a bit. But it was a very regional outlook that came out. So the South specifically dropped 27% in sales, while the Northeast picked up 53% in sales. So you just got to look at those regional areas.
I want to talk a little bit about where you are in the ecosystem of real estate, because you guys operate in a really interesting space. The idea is you buy land and hold on to it until developers who want to build homes want to develop that land, and then you sell it to them. So certainly interest rate environment is really important to you. How do you feel about the rate environment and the rate path moving forward, and how that's going to affect your business?
Yeah, so our clients are typically the largest public home builders, and the rate environment obviously is affecting all of the home builders, but the large ones that have the scale and the ability to buy down rates have been doing just that and been gaining market share in a rising rate environment. It's been good for the large home builders who are more competitive.
So it's okay. That's what's hard to understand, because the idea is when rates go down, people can afford to buy more homes. Hopefully, that's the idea. We haven't really seen that play out necessarily, just because of the supply and demand element here. But how does it affect the way that home builders then come to you to purchase land?
Yeah, it definitely, just because we're typically feeding the land to the largest public home builders, and they're less rate sensitive. The smaller builders that don't have the ability to buy down the rates are more effective and can't really compete in the land space as well as the large builders. We're also purchasing land ahead of needing it right now, so they're keeping it off balance sheet, where smaller builders who are also affected by the mortgages, they don't have the ability to land bank like the larger competitors do. But obviously when rates go down, in that sweet spot, when it goes below 6%, there's a lot of people on the sidelines right now that are waiting for that, and we think that that's going to be coming up into the next year. Probably won't be hitting below 6% this year, but next year could get a lot of consumers off the sidelines.
Katie, one thing I'm curious about, and I want to get your take on this, and we want to get into kind of what people want in homes going forward. I don't know if the mega mansion or the McMansions are gone, but before we do that, we talk about the housing shortages in the United States. It's not just a 1 or 2 or 3 year thing. It's at least 10 years, if not more, and that you don't have affordable housing in great cities, be it New York or elsewhere, for those people who work in the city but can't afford to live there. So it's not just about building housing, but building housing, affordable housing, where it needs to be. So when you guys are acquiring land, is it in major cities? Is it suburbs? Is it really feeding the demand that needs to be met?
Yeah, good question. So it's regionally based, but we are typically on the outskirts of the cities where home builders can build larger scale communities versus those infill locations, because we're dealing on a larger scale land supply. But yeah, absolutely, the home builders have adjusted the type of product mixes that they're building to just for that affordability factor. They're building more efficient floor plans. Everything is getting smaller kitchens, smaller garages, smaller storage, to build a smaller home just to make it more affordable. And they're doing higher density, to your point, Carol, less McMansions and more amenities geared towards the people that are able to purchase the homes. So you're seeing more pickleball courts out there.
That's kind of funny. What's considered affordable? What do you guys consider affordable housing? And I know it's geography, and I understand that, but give me an idea. Yeah.
So the average new home is just hitting around the $467,000 range. And people are moving to the Northeast now for affordability. You can, Youngstown, Ohio, you can get a house for $171,000. It's one of the most affordable markets. And then they're going to where their jobs are located. So, for example, Syracuse, New York has a huge influx of people because Micron's building $100 billion chip manufacturing plant. So if the jobs are there, then it's relative to that market. But Southern California, it's still one of the most expensive markets and one of the most difficult places to build because land is so expensive. So it is very relative, like you said.
Well, that said, you do have quite a few assets in the state of California, quite a few in the San Diego area, a few in the Bay Area as well. What is attractive to you about that area, given how expensive it is and how difficult it is for some home builders to actually build in California?
Doesn't scream affordable to me.
Right. It's the overall fundamentals of people wanting to be in Southern California. So the demand is there, and you have a scarcity of land that's available for development. You used to have this mentality of, people didn't want things built in their backyard, the NIMBY mentality. Well, in California, it goes a step further. It's now called the banana mentality, which is build absolutely nothing anywhere near anything. So it makes it more
I've heard that before.
Have you?
For
No,
land.
I've never heard that. That's the banana, build absolutely nothing anywhere near anything.
Exactly.
Okay,
And that
I'll remember
is
that.
the California, it can be the California mentality. And so if you have the expertise and the boots on the ground to buy the land for the builders, the demand for people wanting to live there is there.
Nuts.
Wow.
Looking at the map of your website in terms of where you guys, I guess, have land and land assets specifically, Atlanta, is it still on fire for you guys, or is that property land just sitting kind of empty and demand has cooled?
There definitely is demand there, but you are seeing less demand in the South. Like I mentioned, the October numbers for the Southeast were down, but I mean, it's still a good place for migration for the affordability factor.
Texas too? Are people still flocking
Texas continues to be a stronghold. Almost all of the top public builders have a very large presence in Texas, but we're moving to places in the Northeast like Delaware, where the public builders have told us they will take all of the land that we can bring them in a place like Delaware, because you've got low property taxes, no Social Security income tax, strong employment, great schools, and the surrounding cities are just much more expensive.
You basically, in 30 seconds, just tell us, you basically have no assets in the sort of northwest quadrant of the United States. I mean, all the way from Iowa to Washington and Oregon. Why is that?
We're going to be expanding our acquisition strategy. So we're going to be entering the Idaho market. We do land bank for D.R. Horton in the Northwest. So we do have some assets holding land off balance sheet for them. So those are markets that we're exploring.
Where's the most expensive place to buy land right now? Just 10 seconds.
Southern California. I mean, California markets are the most expensive and the most difficult.
Hey,
places
that sun is going to,
develop.
perfect weather is going to cost you, Carol Massar.
Of course it does.
Pacific Ocean's expensive.
Yeah.
Katie Hubbard, thank you so much. Executive Vice President, Capital Markets at the privately owned asset and real estate investment company, Walton Global.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We are just a few days away from Thanksgiving. It also means Black Friday, which I think for a lot of people means a lot of shopping. I don't know about you. I'm going to be here working. Are you going to be shopping?
I don't know. I don't like crowds. Like, I like to stay
Interesting.
away.
You live in New York City and you take the subway every day.
And
It's very interesting to hear.
that is very true. Point well taken. But when I can avoid it,
look,
I have to get to work.
I'll be honest. I don't like crowds either.
When I can
I live
avoid
in the same place.
I
so.
just like, no. Anyway.
Hey, I got some numbers for you. Deloitte out with some numbers ahead of the day saying that the people it's surveyed are expected to spend $650. That's between Black Friday and Cyber Monday this year. It's up 15% over last year. It's also a new record.
That's a lot of spending. Also of note in that survey is that for the first time, online-only retailers beat out all other retail formats as the preferred way consumers want to shop. I mean, go figure.
Okay, well, for more on how retailers are thinking about the season this year, we go to Tom McGee, President and CEO at ICSC. It's the trade group that represents the global retail real estate industry, think brick and mortar and more. He joins us once again from New York. Tom, how are you?
Great to be with you guys.
Hi.
Happy Thanksgiving.
Good to be with you. Hey, you actually, it's interesting because you spent a lot of time at Deloitte, so you're familiar with this survey, I imagine. But I'm curious about your thoughts on the online-only portion of this that Carol just mentioned. The idea that for the first time ever, online-only retailers beat out all other retail formats as the preferred way consumers want to shop. You're on the brick and mortar side. How do you look at this?
Well, I look at retail more from an omni-channel perspective. I know that a lot of folks continue to break out retail between online and physical retail, but really retailers are somewhat agnostic in regards to where the transaction is consummated. They know they have to deliver for their customers, whether that's on the online channel or the physical channel. And I think really the only channel matters is the consumer channel. And a lot of online sales are fulfilled out of stores now. Stores are increasingly becoming mini fulfillment centers, so not used just for traditional shopping, but really ship from store or curbside pickup or click and collect. All those things that are initiated from an online perspective, but are actually fulfilled from the store. So I don't look at online, the growth in online sales as a negative for physical retail. I think it just complements it. I mean, quite frankly, the challenge right now for physical retail holistically across the country is the demand for physical space is in excess of the supply of available physical space that's out there.
So where are we in the story, the demise of the mall, be it strip mall, big malls, medium, I don't know, where are we on that? As we do see some retail brands go to the wayside and we do see kind of a filtering out, but where are we in that narrative, that story, that reality, Tom?
Well, the narrative of the demise of the mall has been around for a long time, for decades at this point, but here we are and the mall is still alive and kicking. I think when you think of physical retail, you have to think of it in multiple dimensions. So there is, kind of grocery anchored neighborhood centers. There's, traditional kind of power centers, which are the Target, Costco, Walmart anchored centers. And then there's big malls, which can range from smaller malls to big regional malls. And, it's the discussion around large regional malls is more nuanced. Some are doing exceptionally well. Some are more challenged. The story around kind of the Target, Walmart anchored power centers and grocery anchored neighborhood centers is one of exceptional strength right now. The suburban retail is kind of on fire. And that's where you're really seeing this demand for space exceed the supply of space. So it depends upon which sector you're talking about. But generally speaking, the malls have evolved and they've become much more than just a place for people to shop. They're a place for people to experience a whole host of different offerings, including dining and et cetera. As a matter of fact, I was at the mall last night watching Wicket and went to eat right afterwards. So
where was you're in New York? So just give us. I don't want I'm not going to dox you or anything, but where were you? Because
I won't give you the mall, the specific mall, but I was in New Jersey.
Okay,
which is and that's my point. To some extent, and I do spend a lot of time here in Manhattan. Split time between Manhattan and New Jersey. And Manhattan is its own ecosystem. And so it's important to remember that what we see in Manhattan isn't necessarily what, exists throughout the rest of the United States, particularly in suburban areas.
Yes, that's what I wanted to talk about in these areas of growth here. You mentioned dining, and you've mentioned that quite a few times when you've been on with us in the past.
Yeah.
Is that the area of growth in these shopping centers or these sort of retail areas? You have that big anchor store, the Costco's, the Walmarts, but is it restaurants? Is it dining that's really the growth area?
Well, I not necessarily an open air retail, which is what you just mentioned. So, kind of grocery anchored or Costco, Walmart anchored. Many of those retailers are doing exceptionally well because they're close to where people live, and in a post-COVID, post-pandemic environment. People are obviously working from home a lot more, so they have more time to shop. And quite frankly, the benefit of having that physical retail space close to where people are living was proven out during the pandemic. So that's one of the reasons why the demand for space is so high, because these retailers want to be close to where people live, because it's a chance for them to, yes, have people come to the store to shop, but also to fulfill online orders. It's much cheaper and more efficient for them to either ship from those local stores or have the consumer come to those stores. In the larger regional malls, clearly the mix of the curation of what's in that mall is leaned more heavily towards experiential than product-based retail over the course of the last 10, 15 years. Because they're trying to offer a collection of offerings in those regional malls because they draw from a larger geographic area.
Hey, Tom, what's interesting in the mall and retail shopping space? I'm just thinking about the Bloomberg audience. We talk about retail and consumer, and of course we're getting ready for, the holiday shopping season. But what's interesting from your perspective and you think would be interesting to our audience, an investing audience who are trying to kind of catch trends that might be going away or coming around?
Well, the biggest trend I would tell you is the one I started with, which is the demand for space is in excess of supply of space. And a lot of people are surprised by that. But if you think about just the numbers, basically since the great financial crisis, I'm oversimplifying this, but retail sales have almost doubled during that period of time. GDP's grown by, close to 40%. Physical retail square footage in the U.S. has grown by about 6% during that period of time. So while retail sales have almost doubled, you haven't really had any increase in physical retail space. Now, In some areas in some areas of population growth, you might have had some additional square footage added in the Texases and the Floridas of the world. But generally speaking, in most densely populated areas, it's either remained flat or the amount of space has actually decreased during that period of time. And retailers want more physical space. I mean, most retailers actually want to open up more stores right now because of that last mile fulfillment. They have discovered, while we talk, a lot of media and a lot of investors still talk about online versus physical, retailers really think about it from an omni-channel perspective, and they look at the store as an asset that they can utilize in multiple dimensions, not only for traditional shopping, but particularly for fulfilling those online orders. And in fact, online sales grow in areas where retailers open up stores. It grows not only the physical retail sales, but online sales as well.
Totally get it. I mean, I do that when I sometimes will look for a retailer where I can easily, pick up, drop at a retail store in the city. I will say there's
BOPIS. Buy online, pick up in store.
Right, exactly.
Yeah.
There's some stores, I think, just outside our building. There's some openings for retail space.
Oh, okay.
They're still there, and they've been sitting there for a long time.
All right. Come join us here, 58th Street.
Tom McGee, thank you so much at ICSC joining us right here on Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, it is time now for Bloomberg Plugged In. It's your weekly look at EVs.
All right, so lots of news already this week. It's only Tuesday. Tesla shares were down yesterday. They fell nearly 4% in the Monday trade after Bloomberg reported that the company's EVs would be shut out from consumer rebates under proposal by California Governor Gavin Newsom, pitting the prospective Democratic presidential hopeful against Republican power player Elon Musk.
Elon's not happy about this.
A little bit of a battle. Well, listen, it used to be his home state, right?
It did. He pointed out that he said this on X, so I don't know if I haven't fact checked it, but he said that Tesla is the only one that makes EVs in California.
So interesting. So we're a little bit of a battle here. So we have a great guest to get into this.
We do. We got Andy Bennett with us. He's CEO of Driivz. It's a company that provides EV charging management software. It's part of the $5.8 billion market cap publicly held Vontier Corporation. Andy joins us from beautiful Boulder, Colorado. Andy, how are you?
Great. Yeah. Thanks, guys. Nice to meet you, Carol, Tim.
Good to have you with us. Hey, explain exactly what battery management software does. I mean, I think we all understand that you can't just charge your iPhone over and over again and expect the battery to last the same as it did on the first day 4 years later. Where does the software come into that?
Yeah. So in general, we think about batteries in two ways, right? Of course, there's the batteries that are in the car, right? So you have a battery management system that optimizes the use of that energy. But batteries are becoming more and more important for EV charging. In places like the United States, you have lots and lots of areas that effectively are constrained from an energy perspective. And so you can put large batteries in those areas. You can control the flow of energy, so you can increase the number of cars you can charge. So batteries, when you're thinking about EV charging, there's really two parts of the equation. The first is that battery in the car, how it's behaving, how it's being utilized. And then those batteries that are going to be at gas stations all around the country, they're going to give us extra capacity to really keep that charging experience as quick as possible.
So, okay. So I'm just curious about, it's interesting. I'm listening to you talk and I'm thinking about when we talk about the EV world, Andy, a lot of what comes up is about range anxiety or people being able to find a place to recharge. If I pop on a highway out to Connecticut, I see them, the rest stops, they all have them. But in New York City, it's still really challenging. So I understand what you guys are doing, but I feel like, is this the cart before the horse in terms of having enough places just where people can charge before we kind of take it to the optimization level, which sounds like what you guys are doing?
Yeah, no, we do a little bit of both. So we build the software behind the world's largest charge point operators. We call them CPOs. So think about EVgo as a great example, or Shell. And that software is looking after the health of all those chargers out there. Is the network working? Is it running? Energy is just one part of that total equation. Are you able to bill? Are you able to show up to a charger and actually, use your credit card to go make that work? So without that, without that fundamental software, there is no charging, right? It's the infrastructure software that makes it work. But you're absolutely right. When you think about the frustration that folks have today, it kind of comes in two sort of flavors. The first is when I get to a charger, is it available, right? And then if it's available, is everything working? And as we've seen in the last couple of years, reliability is going up and up and up and up, which is great. But then you nailed it. The second part is we just don't have enough charging today in place, enough public charging. So if you think about the United States, today we have roughly, let's say about 200,000 available chargers to people. Most of those are what we call AC chargers. So they're a lot slower than the DC fast chargers that you might see on the highway. And if we were to keep up with really just the current sales that we have in EVs right now, by the end of next year, we would still need to build 4 times more charging infrastructure in the United States to meet that demand. Some of those projections say by 2027, 2028, we would need to build 8 times more than what we currently have, just to satisfy that, what you just mentioned, of course, which is range anxiety.
So a Trump administration, are we going to then ramp up the building of these? Because it does sound like we need them. Like, what are your expectations around policies in the EV world and what it means for the industry and your business?
Yeah, I mean, look, it clearly there's some headwinds with some of the administrative changes. Some of the things that could be changed is, we could get a drop in passenger EV adoption, right? So if we don't have, the incentives, then some folks just aren't going to go buy those cars. Now, having said that, for a company like ourselves that is building the software for the charge point operators, there's still such a huge gap between having enough of those chargers out there to deal with the current requirements, versus what's actually there, that some of us in the industry are happy to kind of get a little bit of a catch-up time there. So no doubt, I think if you think about, right now, where are we in terms of charging infrastructure growth for the year? Most of the projections at the beginning of the year said, look, we'll probably end up at around 30% year over year growth in public charging. We actually know it's probably closer to 36 or 38% growth. It's just an incredible CAGR. Right? Think about that. That's a massive amount of infrastructure that big CPOs are building as quickly as they can. And I think often we spend a little bit too much time maybe associating that build out with the NEVI funding, the federal funding that came out. Most of that infrastructure spending happened way before the federal government ever started to step in and incentivize. So look, we still have a ton of demand. The big CPOs are still building at just breakneck speed. That's going to happen. It may get a little bit compressed, of course, but it's still going to happen at a very, very fast rate, independent of the whole NEVI funding pathway.
I'm wondering about just a basic question, Andy. If we think about where all the gas stations are in this country, why is it cost prohibitive for these gas station owners to just add 1 or 2 EV charging systems to their existing gas stations? Like, why is this so difficult to do?
Yeah, Tim, that's a really great question. For me, I kind of to look for that answer, one of the best places to go look is in the Nordics, right? Where we know today over 90% of all new cars are EVs. You look at the UK, you look at Europe, which is, by the way, one of the places my company has been for years helping charge point operators. What you see is some gas stations are really well suited for electrification, and some aren't. Maybe a couple quick comments about that, because no matter what, we believe that the winners in this marketplace are going to be the fueling stations that also have other things, other amenities, other conveniences. So when you're in Oslo or you're outside of Oslo, whether you're in the urban area or you're on the highways, what you see is EV charging stations that have outdoor gyms, they have incredible food, clean bathrooms, really nice amenities. The second you show up at one of these stations, you connect to their Wi-Fi, and you start to get coupons to go inside and save 10% on a cup of coffee. It's a really, really integrated experience. And we certainly see some of the larger retailers here in the United States starting down that pathway. Apple Green, if you've ever driven on Route 95, is a perfect example as you go through New Jersey, extremely innovative around what that experience will look like. But having said that, some of those places just aren't great spots, right? They may not have the ability they might not have just the real estate to bring that in. They may not have the conveniences. And remember, the average wait time is probably about 22 minutes today as you're charging on a DC fast charger. So you generally want to get out of the car. You're going to expect other amenities. But when you go back to the European example, what we do see, especially in the urban environments, is a slower, more methodical transfer. So over time, they don't just go 100% electric at those stations. They may have 10 fueling pumps and 2 DC chargers to start with, and then they slowly pull out those pumping stations. Circle K is a great example in Europe where they have done this really fluid transition as the economics make sense. That DC fast charger is expensive, so just the way to think about it is break even on that investment, probably close to about 11% utilization. Right? It has to be being used 11% of the time that it's there.
I will say, Carol, my trip to Norway a few years ago, the infrastructure just makes you cry when you compare it to U.S. infrastructure. The tunnels are incredible. Just drill right through these mountains, miles long, totally well lit, not crowded at all. Unbelievable.
Maybe Elon's onto something with the boring company.
Not yet.
Just saying.
Not yet.
Hey, just got 30 seconds, Andy. In a nutshell, or a word or two, how do you describe the EV market today?
Look, we make software behind these charging companies. We can barely keep up with the demand, and the growth that's taking place has been incredible. We're a company that's doubling year over year and just building the things these folks need to be successful. For us, a huge portion of the market still remains in Europe. The United States is just starting to grow.
Yeah.
I think we're going to see a little bit of a dent taken out of passenger EV charging. Nothing is going to stop the electrification of large-scale fleets, though. That is picking up at a pace that is really fantastic. And why that's relevant is, as that continues to be successful, we're going to see, whether it's a passenger or a truck, co-charging at these different places. So the infrastructure is going to continue to roll out. At the end of the day, if you build a car, right, there's 2 things you can do to go get people to buy an EV car.
Right.
Cut the cost of the battery and get more EV infrastructure out there.
Totally makes sense. Andy Bennett, really enjoyed this, CEO of Driivz, joining us right here on Bloomberg Businessweek.
That's Driivz.
Very cool.
Yeah.
I love that.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
It is the Drive to the Close on this. Wow. How do we get here, Carol?
Which one? Tuesday,
November 26th. It's almost it's almost time for Thanksgiving.
I don't know. Let's see what Alan Lancz has to say, because time flies when you're having fun. Director of Research at LanczGlobal.com, President of Allen B. Lanz & Associates, with us once again from Toledo, Ohio. Hey, nice to have you here. Forgive the shortened session today, but of course, breaking news trumps all other, certainly here at Bloomberg, and rightfully so. We are watching, though, the news out of Washington, the geopolitics. What's changed in your view since Donald Trump was elected back into the White House?
Quite a bit, Carol. Obviously, everybody's looking at the glass half full. Some sectors have really underperformed, like, the financials, because of the potential of deregulation have really, outperformed. And you've seen a good broadening out, which is very healthy of the market, where, it's not just the Magnificent Seven, or tech, communication services, but it's small cap, mid cap, and quite a few participants now in this rally. So that's been healthy, and it was fairly predictable. There were a lot of stocks, including like software and tech, that had underperformed. That there's some key advantages. They're well positioned for AI and what's going to happen with the advancements of AI, and that's starting to get investor attention, and companies like Snowflake and MongoDB are starting to move.
Okay, so let's talk about some of these companies. You mentioned Snowflake; it's one of your picks right now. The company reported earnings in recent days. Why are you bullish on Snowflake?
Yeah, Tim, we recommended it in June. We figured they just had a bad quarter. The stock moved down from 300s to as far as the low hundreds. Actually, we recommended 124. It went to 107, so we just kept on buying. We knew there was going to be another quarter or two, and really over the past week, they reported better than expected results, and the stock has moved up, and that's happened with quite a few. MongoDB, Datadog, etc. I think investors are starting to see that, they can ride the coattails of some of the Magnificent Seven.
Okay, we don't have a ton of time, so I want to get to one more. Forgive me, we only have 30 seconds. Dell, they report earnings after the bell today. Why are you bullish on Dell?
Then we like Dell. We wouldn't chase it, so basically we'd have it a hold here. But it's one that when it broke 100, just like Nvidia, these companies are really volatile. So buy when they're out of favor, and take some profits if you do see a spike with the Dell earnings tonight.
All right, Alan, thanks so much for joining us this afternoon. Alan Lancz, Director of Research over at LanceGlobal.com, President of Allen B. Lancz & Associates, joining us from Toledo, Ohio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.